Hello students, today we will discuss very important point of financial management that is called dividend decision and policy. My dear students, let's start with the term of dividend. Dividend is a part of profit distributed by the company on the end of each profitable year. It is a right of investor, it is a right of even equity shareholder on account of their investment in the firm. Investors are interested to get maximum returns and maximize their wealth. On the other hand, company require portion of profit in the form of retained earnings to fulfill their future expansion and growth. If company distribute whole amount of profit among its owners, it must arrange funds from external sources, which result into higher cost of capital or higher number of equity shares, which finally ended up with the minimization of company's wealth. Let's discuss about the effect of dividend on firm's value. The value of the firm can be maximized if shareholders' wealth maximized. There are two conflicting views on the effect of this dividend decision on the valuation of firm. As per the first school of thought, there is a direct effect of dividend decision on valuation of the firm, whereby as per the second school of thought, there is no effect of this dividend decision on the valuation of the firm. Let's start the first theory. There are two theories. The first theory is theory of irrelevance, whereby it is considered that there is no effect of the dividend decision on the value of the firm, and as per the relevance theory, there is an effect of the same thing. Fine. Now let's start with the theory of relevance. In the theory of relevance, as we have already discussed, in case of residual approach, there are two approaches. Number one is residual approach and the second one is Modigliani-Miller model. As per both the approaches and model, they have mentioned that there is no effect of this dividend decision on the valuation of the firm. Now let's discuss about the residual approach. As per the residual approach, this is the basically decision of the firm owners. It is the decision of the management of the company whether they want to retain profits with them or they want to distribute it among the shareholders. So as per the approach, the first point is there is no effect on the prices of share and obviously on the valuation of the firm. The second is it is considered as a financing decision. That means it is completely wholly solely prerogative of the management whether they want to pay dividend or they want to retain earnings with them. The overall residual approach is based upon the assumption that investors do not differentiate whether company retain earnings with them or they pay returns to them in the form of dividend. Now let's start with the second model. It is known as Modigliani-Miller model. It is based upon so many assumptions, but in crux they have mentioned that there is no effect on shares of prices or valuation of the firm. The value of firm is basically determined on the by its investment policy. So company may decide the splitting of earnings into retaining or distributing the dividend. Now let's discuss about the assumptions. There are so many assumptions. The first assumption, there are no perfect capital markets. The investor behave rationally. The information about the company is available to all equity shareholders without any cost. There are no flotation cost or transaction cost. No investor is large enough to affect on the market price of the shares. There are no taxes, or either no taxes, or there should not be any differentiation between the taxes on dividends and taxes on capital gains. The next assumption, it is the firm has a rigid investment policy. And the last one, there is no risk or uncertainty in regard to future of the firm, which was dropped later. Now let's see what is the argument in favor of this MM model. As per this MM model, whatever the exactly increase in value of firm will be exactly offset through the decline or increase in the value of equity share prices. Now, what does it mean? Due to existence of external financing, company has to pay to the external debtors. This is the reason. Fine. So, let's understand the argument. If company has investment opportunity and it distribute the whole amount of profit among its shareholders, company has to raise funds through external sources. In that case, the company either issue new equity shares or generate funds through debt sources. It results into either increase in number of equity shares or increase in cost bearing funds. Both will definitely result into decline in the value of the firm. In the next video, we will try to calculate and try to get the idea about the effect of this dividend decision on the valuation of firm on the basis of this MM model. So, thank you. Happy learning.